Hello, hello, hello. Good morning, everyone. And how's your day going? I hope your day is going well so far. We thank God for another beautiful, wonderful day. The sun is out, so we are happy. You don't see this every September in in the UK, in the middle of September, and we're experiencing this Indian summer. So there's every reason for us for us all to cheer up, if not for anything, for the fact that you're alive and you can take part in what we are doing. So thank you very much for tuning in once again. This is Modesty's Mortgage Masterclass, where every Wednesday we gather here to educate and enlighten ourselves on the latest developments in properties and the mortgage market, ensuring that we are up to date with our mortgage information and ensuring that we are doing everything we possibly can to get ourselves educated, to take advantage of whatever the market has to offer, and to avert some mistakes that we would ordinarily make if we don't have that knowledge. Hi eBay, good morning. Thanks for coming on. So education and information and knowledge are the things that we can equip ourselves with to help us make a more informed decision, and that is what this particular program is all about. The masterclass, the mortgage masterclass, is all about empowerment, education, information, and equipping you with the necessary tools to make the right decisions when it comes to properties and mortgages. I remain your man, Ikenna Omezudike. I am the director of Modesty's Financial Consultants Limited. We're a financial consulting business based in Luton, United Kingdom, specializing in mortgages and protection, financial advice, and consulting. Okay, so today, what I asked this question on my social media: is the house price is going to significantly drop in 2021? And then what's happening with the mortgage rates? And these are the things we're going to discuss in this particular session. And we're going to see exactly in what direction the house prices are likely to be going, or they are going at the moment, and what's the probability of that being sustained or not being sustained, and all the arguments around that, and all the suggestions and all the expert analysis around that. That's what's coming your way. But like I always do every Wednesday, I start this program with the positive vibe of the week. It's meant to bring some air of positivity into what we do, and just to make you understand exactly why we love doing what we are doing. And a lot of positive vibes that are coming from clients and from friends and from people that know me, that relate with me, and that relate with what we do. And they give us this positive vibe, and we are bringing it back to you for you to also know that there is positivity around you if you choose to focus on the positive things. So the positive vibe of the week today is coming from a phone conversation I had with a client whose case I'm still handling at the moment. But the positivity from this client already is so much that I just felt there's too much of it, and let me share some of it with my audience today. So I'm going to read out an excerpt from the phone conversation I had with this client and what the client had to say to me in return. So he said to me, I'm going to read it out. Ikenna, I don't care what the outcome of this mortgage is, even if it turns out bad or not what I expected. I will still come and say thank you to you. You have really done more than I expected already, and I didn't even think we are going to get this far in this mortgage process. But you have been patient, understanding, and helpful. You've been treating this case as if it's your brother's mortgage. Knowing you was the best thing my accountant did for me this year by referring me to you, and we can't thank you enough. So this is coming from my very, very well-beloved client, Chidozie Chibu, and his wife, Onyinye, in a phone conversation I had with them. And this is a case that, somehow I'm very much attached to it emotionally, because I really, really want to make this work for them. They've been fantastic as a couple, and we've struck this very good relationship with them, like I do with all my clients. And this is just a reflection of how I deal with my clients' cases. I take them personal, because I always feel like if I were in their shoes, how would I feel? Our job and our business is all about fulfilling dreams. And when I see people's dream fulfilled, helping them get their dream homes, or helping them get that remortgage they're looking for to achieve what they want to achieve, it just fills my heart with so much joy. So I pour everything into it to make sure that dream comes true. So maybe that was what came across to this client, and he left me with this fantastic message. So Chidozie and Onye, thank you so much for the feedback, and I really, really do hope that we make the most out of this opportunity, and will give you, the best attention that you deserve. All right, so that's the positive vibe of the week out of the way. Now let's talk about what we are here to talk about today. First of all, let's talk about the rates. Yeah, the mortgage rates. What's going on? Yet again, the rates have gone up. Yet again, the mortgage rates have increased, and they keep increasing. And this is the fourth consecutive month that average mortgage rates have gone up. So now from Money Facts have a survey by Money Facts, and a report from Money Facts is saying that the average fixed rate has risen to the monthly highest average in a decade between August and September. This is a revelation from Money Facts. The monthly highest level of average fixed rates in a decade, in 10 years, by Money Facts. So according to Money Facts, over the course of last month, the average 2-year fixed rate of a mortgage across all loan-to-values rose from 2.08 to 2.24%. That's a 0.16% increase on average across all loan-to-values. Okay, remember, across all loan-to-values, not just the high loan-to-value mortgages or the lower loan-to-value mortgages. This is the average across all loan-to-values. So this month-on-month increase is the steepest that it has risen since July of 2009. And that was on the back of the financial crisis. So for the past 10 years, this is the steepest month-on-month rise in average mortgage fixed rates across all loan-to-values since that record 2009. And then that's for 2-year fixed rate. Then the 5-year fixed rates increased by almost the same margin in the same period. The 5-year fixed rate average increased from 2.34% to 2.49%, and which is the biggest increase of a 5-year fixed rate since March of 2011. So what is going on? But then, even with the steep rise in the average fixed rates for these mortgages, in both the 2- and 5-year mortgages, there are still the 2-year fixed rates on average was still like 0.19% lower than what it was pre-lockdown. Okay? And it was still 0.25% for the 5-year fixed mortgage. It was still 0.25% lower than what it was before lockdown. Right? So remember, what we are measuring is how steep an increase it's been over the last 10 years or since 2011 in the case of 5-year fixed mortgages. But then, if you even with that steep rise, yet the 2- and 5-year fixed rate mortgages are still lower than they were before the lockdown. So the 2-year fixed rate was still 0.19% lower than it was before lockdown, as well as the 5-year fixed mortgage at 0.25% lower than it was before the lockdown. So, and this is the 4th consecutive month that mortgage rates have risen. And not just the rates that are rising. The mortgage fees, the product fees are also increasing. So average mortgage fee now stands at about £1,032. On average, the product fee or the mortgage fee payable by borrowers when they borrow. Because the lenders do charge what they call either product fee or arrangement fee or mortgage fee, whatever they call it. Yeah, it's a fee associated with borrowing or lending from a lender. So it stands at an average of £1,032 now. So it's not just the rates that are rising. The average fees are also rising. And this is the highest it has been for the fees since February of 2013. Since February of 2013, this is the highest it's been on average for the mortgage fees. Okay, so we've talked about the rates going up, average fees going up. Now, what about products, the mortgage products in the markets? In what direction is it going, up or down? Now, listen to this. While the rates are on the rise, the fees are on the rise, the products in the market are on the decline, downwards. Yeah, so the available mortgage products have reduced by 114. So there are 114 fewer products that are available in September. So total number of products. Hi Costa, good morning. Thanks for coming on. Total number of products available as at September was 2,412 mortgage products, and that is the lowest level of product availability in the mortgage market since 2009. Hi Donald, good morning, thanks for coming on. Since 2009, the lowest level that the products have been on the market. So there are less and less mortgage products available. Yet the few that are available, the rates are increasing and the fees you pay for accessing them are increasing. So you see, the contraction in mortgage products available it represents a 54% drop in the number of products that were available as at March. As at March this year, there were over 5,220 mortgage products available. And now we have just over 2,400 products available. So month on month, and as time goes, the lenders keep withdrawing products from the market, and the number of products and the amount of products available for borrowers keeps shrinking on a monthly basis, yet the rates keep going up on a monthly basis. So what does all this mean, and why are all these things happening? Why is there a contradiction in the number of products that are available compared to the rates that we have to pay for those products? Why are they going in the opposite direction? You see, it must be a disappointing thing and time for consumers at the moment, because the mortgage rates are rising, and even with the reported increase in housing market activities in August, you would think that lenders would be, encouraged to come to the market with more products. But what we are seeing is, even with increased market activities in the properties market, the lenders are withdrawing more products from the market and raising rates on the ones that are available. So you would have expected that demand, the surge in demand and the increased activities in the housing market to really trigger some kind of enthusiasm and interest in the lenders to come to the market with more products. Hi Lady T, good morning, thanks for coming on. So and because you would be thinking, oh, the lenders would have seen that there is so much activity going on, let's go and grab our own share of the market, let's flood the market with products. But the opposite is what the lenders are doing. So it is then noteworthy that even with the recent rise in the average rates, they still remain lower than they were before the lockdown. But then the rates still, the rates at which the rates are rising have gathered pace recently. Now, over the last 2 months, in fact, the increase in rates have doubled. The rates have doubled over the last 2 months. And you would begin to imagine, why is this unprecedented rise in interest rate? Why is it so consistent? Why is it so constant? Why do lenders keep, why do they keep raising the rates? And it's a concern for everyone. But I'm going to come down to that reason later. But what experts are warning here is that if it carries on at this rate, consumers might end up paying, in the next couple of months, consumers might end up paying more than what they were paying for their mortgages before the lockdown. That is, if this trend continues at the rate, because for the fourth consecutive month, we have experienced increase in rates, even though those increases are minimal, but they are steady. And the experts are saying if it continues at this rate, in the next couple of months, the average rates in the market would even have surpassed what it was before lockdown. So with these rates increasing and very limited product availability, especially in the high loan-to-value category of the mortgage market, and this high loan-to-value category normally carries a higher interest rate. So you can then imagine, without the higher loan-to-value mortgages being available, like the 90-95% loan-to-value mortgage being available, which normally comes at a higher interest rate, without those products being available, and the rates are the average rates are this high, imagine what will happen if lenders now launch those higher loan-to-value mortgages in the market. Obviously, it's going to shoot the average rates up. So it just begin to imagine what would happen if these higher loan-to-value rates come into the market. The consumers are going to be worse off, basically. But the lenders are doing this because something is happening in the lending world, which I want to let you in at the moment now. You see, over the recent years, there has been stiff competition among the lenders. Before the lockdown, over the recent years, there has been stiff competition in the mortgage markets. And the lenders have been reducing rates and lowering their margins. And it's been, their profit margin on mortgage products have been shrinking because of competition. Because everybody wants to grab their own share of the market. So their profit margin for mortgage products have been shrinking over the last couple of years, in recent times, before lockdown happened. Now, with the increased competition reducing their profit margin in mortgage products, and then lockdown now happened, what do you think their outlook for margin and for profitability will look like? It will look even gloomier. They're going to sit back and think like, well, hang on a minute, even without the lockdown, right? We are even struggling to make that much profits. Now with the lockdown happening, the volume of business that they are doing with the lockdown is not the same as they used to do before lockdown. It means they cannot offer all their full product ranges out there in the lockdown, because not all those products will be profitable enough. And even if they are going to be profitable enough, they don't have the staff capacity to process that many requests and that much demand coming in. So their capacity have been reduced by the lockdown. And if their capacity have been reduced by lockdown, it means reduced volume of business for them. So, and they've got stakeholders. They've got to pay wages. They've got to pay bills. So somehow there are a cocktail of factors that have driven lenders to really continuously add a little bit onto these rates, increasing these rates gradually month on month, because profits, the margin, has to be reasonable enough for them to be in the markets. Secondly, they want to discourage people. They want to discourage increasing demand for the product because they can't cope. So if they have to take in all these requests, then it has to be worth it. So it's a way of controlling demand by increasing price. It's a simple economic tool, isn't it? If you want to control the demand, you can control that using price. So, and the price they're using to control demand here is by increasing rates. And by increasing rates, it's increasing the bottom line, which is like, the margin and the profits level. Because the market, as competitive as it is right now, not all the lenders' products are suitable for everyone in the market. Because the market is not as open as it used to be. The caliber of clients and consumers and customers who are in the market now are not the type that's, ordinarily would have been in the market in normal times. There are a lot of people who have been priced out of the market at the moment who are not even on the market, especially first-time buyers. So there are a few first-time buyer products in the market. That's the 90-95% loan-to-value products in the market. There are a few of them in the market. So if there are a few of them in the market, like the products, it also means there are a few first-time buyers in the market, because not all first-time buyers in the market can come up with 85%, 15% deposit. Only a few of them can. A lot of them are having to rely on a 5% deposit, and a lot of them are now having to go through the help to buy scheme of the government, because they cannot get 90-95% mortgages. Okay, so there are limited number of people in the market, or category of consumers in the market that these lenders are after. And because not all the products are available in the market, they have to be really sure that the ones that they are offering in the market are the ones that will give them good margin. And because 2020 and the virus and the pandemic have really shrunk their profit margins, they have to show up these margins somehow, which is part of the reason the rates keep rising month on month, right? And also it has to do with the economic outlook. How are the lenders viewing the economy? What do they think the economy has got to offer? The uncertainty in the economy at this moment in time is giving the lenders cause for concern. And because it's giving them cause for concern, the lenders are just trying to play it safe. So if you can afford to pay our rates, we don't mind lending you, providing other things fall into place. And you would think that with the Bank of England base rate at its lowest ever level, you would be thinking that the lenders and the mortgage rates would be at its lowest level. It was between March and April. Yeah, and immediately I think between March and May, yeah, but since July, it's been creeping up since July. The rates have been creeping up since July. But immediately after the lockdown in May and June, the rates were really almost unbelievably so low. And then in July, the lenders started, the rates started creeping up a little bit. So what all this tells us is, with the rates rising, with the economy not looking so good, with fewer products in the market, with increase in product fees, as a consumer and as a borrower, it has never been more important for you to seek independent financial advice if you are looking to enter the mortgage market. Because first of all, you need independent financial advice from a qualified mortgage broker, especially a mortgage broker who has access to whole of markets. Akbasiri, hi, good morning. Thanks for coming on. Lady T, Linda, thanks for coming on. So it has never been more important for you as a consumer to go and seek independent financial advice, because the independent financial advisor, who is a mortgage broker, will help you find the product with a cheaper product fee, will help you find the product with a cheaper rates, and will help you find a product that suits and matches your circumstances. Because I've always said it, and I will repeat it again, that the best mortgage product is not always the mortgage product with the lowest rates. Because the mortgage market now is no longer just based on rates and rate prices. It is a criteria market now. Okay, people have diverse and different, characteristics and different factors affecting them and their mortgage requests. There are different features of every customer. There are different challenges everybody faces. There are people who are employed, some are self-employed. Some who are self-employed with complex income. Some are contractors, some have adverse credits. Some, some are married, but they want the mortgage to be in their single name. Some have got, jobs, and they have got other sources of income. They are not sure that it is going to count towards. And it's not every lender that will accept. For example, there is a case I was dealing with earlier this week, right? Child working tax credits and child tax credits, and then child benefits. Not every lender accepts some of these as part of your income in assessing your affordability. So these are the things that the professional mortgage broker or the financial advisor will have to fit in to be able to find you the lender that matches or suits your criteria. So it's not about who offers you the lowest rate. The lowest, rates are just one part of it. But there are multiple factors that need to be factored in to find you the perfect mortgage for you. So the perfect mortgage for you might not be the one with the lowest rate. It might also be. But then, as long as it ticks all the necessary boxes for you, especially if your situation or your circumstance is peculiar, you've got to find a peculiar lender for your peculiar circumstance. All right? So with all these things happening in the mortgage markets, if you are in the market for a mortgage or trying to buy don't try and say, let me save myself, this £1,000 or £1,500. I would rather do it myself and then get in touch with a professional advisor. Seek professional advice. You will find out that that professional advisor, they are worth their fees. The work they do for you and what they will get for you is worth it. Pay it and get the value, but make sure you're getting value. And especially with a mortgage broker, work with a mortgage broker who has access to the whole of markets. Okay? So that's about the rates. Now, let's talk about house prices. A house price is going to fall significantly in 2021. Okay, what are we hearing? Now, with there is a think tank, there's a body called Center for Economic and Business Research. So they've carried out a research and a survey, and they've come out with this very bold declaration or forecast, I would say. They've come with this very bold forecast that house prices are going to drop by 14% in 2021. And by 2021, house prices are going to be 14% lower than they were in 2020. So tell me something. If my house is worth £100,000 by the end of 2020, so by the end of 2021, that property is going to be actually worth 86,000. Is that what these guys are saying? Now, I can see two different reactions here. Homeowners are like saying, nah, this can't happen. And then buyers, property buyers are saying, yes, come on, let it happen. Those are the diverse views and reactions that you get from information and from news like this. But let's not just take the headline for what it is. Let's dig deep and dive deep into this and see where this forecast is coming from and why they are forecasting this. So, the CEBR, Center for Economic and Business Research, they believe that the recent surge in market activities in the housing market is not sustainable. That's what they believe. So they believe it's a short-term surge and it's not going to last long. Because recently, there has been, the activities in the housing market have really surged. There has been a lot of participants in the markets. A lot of buyers coming to the market, a lot of sellers coming to the market recently, and it's been like a mini boom in the property sector. The rising house prices have been good news for homeowners, but bad news for home buyers. So in August, the Halifax House Price Index puts house prices at record high rates, at record high. But this think tank, the CBR, believes that that was obviously against the odds. They believe that the housing market defied gravity in August with that Halifax Price Index. So they think that Halifax Price Index was not realistic. And I'm going to tell you why they think so. So according to them, that trend doesn't conform with what the economic reality is in the UK. That the economic reality is going in different direction, and then the house price index, as postulated by Halifax and Nationwide and other lenders who are carrying out their own survey, is going in the other direction. So it defies gravity. And then one obvious factor they have pointed at that is responsible for that unrealistic surge and unrealistic house price situation is the recent stamp duty holiday. So they believe that with the recent stamp duty holiday, that house prices would be it would mean 1.2% increase in the house price and a 6% increase in transactions in the property industry than it would have been if the policy was not in place. In other words, this think tank believes that the stamp duty holiday has increased the house prices by 1.2% and has increased transactions in the property industry by 6%. Now, if this policy was not in place, they would be expecting house prices to be 1.2% lower than it is now, and they would be expecting transactions in the property industry to be at least 6% lower than what we're experiencing now. So the CBR now thinks that this temporary policy will result into a more dramatic short-term effects in the housing market, and especially as people will be rushing to beat the deadline by April 2021, when this stamp duty holiday is going to end. It's going to end in March anyway. In April 2021. So by April 2021, they are thinking that between now and the first quarter of next year, there's going to be a dramatic movement in the housing markets, some kind of up and down swinging situation. And closer to the end of that stamp duty holiday in March, there's going to be a mad rush for people wanting to meet up with the deadline and wanting to conclude their deals before that stamp duty holiday ends. And because of that stamp duty holiday as well, in between, they are also saying that that's why there has been so much activity in the housing market, which is why they are calling this current trend a define the gravity situation, because as far as they are concerned, it does not conform with the economic reality. So the pent-up demand, also driven by the backlog of transactions from the lockdown, is another factor that the CBR is pointing out. This pent-up demand refers to transactions that were put on hold because of lockdown, and immediately the lockdown was eased and the restrictions were lifted, people needed to get deals that were put on hold needed to be finished, needed to be done, and needed to be dusted. So those accumulated deals and those accumulated transactions now added to what is currently going on, and it's part of the whole craze around housing market activities and all that. So that pent-up demand driven by the backlog in the transactions that were put on hold pre-lockdown is another factor that is driving this crazy activity in the housing market, according to the CBR. Now, between March and June this year, 246,000 home sales were completed in the UK. 246,000 home sales in the whole of UK between March and June. Under normal circumstances, yeah, it would have been 394,000 homes if the average activity between September 2019 and February 2020 were to be maintained. So the normal average under normal circumstances between September 2019 and February 2020, under normal circumstances, normal average would have meant that 394,000 properties should have been completed. Property sales should have been completed by between March and June. So that's number, that expected number, minus the actual transactions and sales that happened between March and June, now gives you an indication of the number of purchases that were put on hold pre-lockdown. And that comes to about 150,000 purchases. So about 150,000 purchases were estimated to have been put on hold because of lockdown. And then, so imagine the moment lockdown and restrictions were lifted, whoosh, 150,000 unsold, unfinished property sales businesses unleashed on the property market. So you can imagine what that has done to the property market. And that's what CBR are saying, that these are the things that are driving this crazy situation. The pent-up demand, the stamp duty holiday. Yeah, those are the two factors that they have pointed out so far. Now again, there are figures from the Royal Institute of Chartered Surveyors pointing towards the early arrival of buyers in the markets and sellers. So they are saying that buyers arrived earlier in the market after lockdown than the sellers. And because the buyers arrived in the markets before the sellers after lockdown, it's driving up demand as well, because it means that buyers were on ground. I mean, it's just like going to the market and waiting for the shop owner to arrive. And then by the time the shop owner arrives, the queue is already, this long. Okay, I'll give you an example. So when I went to, we went on holiday in Nigeria last year, and we needed to go and buy, there's this local wine called palm wine. Yeah, we need to go and buy palm wine in a local market. Palm wine is a local wine that is tapped from a palm tree in Nigeria. It's a very, very healthy, nutritious wine, but it's alcoholic as well. Okay, I'm not going to tell you a story of what happened the day I drank it. I drank a very sweet one. I'm not going to tell you what happened then. Okay, but let's focus on what we're saying. I will tell you the story another day. So we went to buy palm wine. So we got to the market, and then we had to wait for the palm wine sellers to come to market, because if you wanted to get the best of the palm wine, you have to be at the marketplace very early, in the local market, very early, before the sellers will even arrive, so that you can get the best and you can get as much quantity as you would like. So we arrived at that palm wine market early enough, and then we even had to drive past the markets in search of the sellers. And then on our way, we saw one woman coming to market with her palm wine, and we stopped by and we said, listen, let us save you the stress of carrying this heavy gallon of palm wine to the market. Let's buy it off you here and now, and we're going to pay you. We tasted the palm wine. It was good. We liked it. And we said to the woman, okay, we can even give you a lift to the market, because she said, oh, my son is at the market. I need to go pick it. So we can even give you a lift to the marketplace. But look, we are taking the whole supply here that you have. So we kind of cornered that palm wine, and we We policed it and made sure it was in the car. We carried the woman to the car in the car, and we dropped her off at the marketplace. And we even bought whatever she had with her son waiting for her at the marketplace. So that's just an indication of what happens when buyers arrive at the marketplace before sellers. Okay? It's going to drive up demand, and once it drives up demand, drives up the price, because the woman had to add price. You know, she had to increase her price because the demand was there. We hijacked the palm wine on the way. If she allowed other bidders to come in, she would have achieved more. So she said, if you don't want me to bring other buyers into it, then you've got to pay me what I'm demanding. And because we knew the demand was high, we had to pay her what she wanted us to pay her. And that's just what it's like. So the Royal Institute of Chartered Surveyors are saying that after lockdown, buyers arrived the marketplace before the sellers. And that's, drove up the demand. And accompanying that drive in demand came increase in house prices. Then the other major factor propping up the market again, according to the CBR, is supply. Supply is short. And this short supply has been exacerbated by the recent government policy of banning repossessions and forceful evictions by landlords. So in August, the government extended the ban on evictions till end of September. It was meant to end on the 23rd of August. And the government, last minute, extended by another 4 weeks. So landlords cannot evict troublesome tenants or tenants who have not paid their rents. Banks cannot repossess properties if you are in arrears with your mortgage. So this ban, this policy, has affected supply in the marketplace. Now let me give you an example. Let me put that into perspective. According to the Ministry of Justice, in the second quarter of this year, only 161 mortgage repossession claims, those are claims, were issued. That's the figure from the Ministry of Justice. Now to put it into perspective, in the same period or within a quarter, in a typical quarter, around 6,000 mortgage repossession claims are usually received by the Ministry of Justice. 6,000 in a typical quarter. But then now, in second quarter, only 161 claims were issued. So compare 161 to 6,000, and then you will see how much effect this is having on the supply of properties. And then out of that 6,000, usually only 2,000 properties are taken into possession. Typically in any quarter. This is the figure according to the Ministry of Justice. So this is what the CBR have pointed out. So because the repossessed property would have been part of the property supplies. So imagine if 2,000 of these repossession orders were issued and 2,000 properties were added in that quarter to the already existing properties that are in the marketplace, because those repossessed properties are also part of properties that will be in the market. So imagine what that would do to house prices and what that would do, how much that would dilute, the supply, the supply value that we have now, the supply volume that we have now in the marketplace. So because those repossessed properties would have boosted supply, so lack of those repossessed properties, because they're not part of the supply volume now and number now, it has affected the number of properties available in the markets to sell and has affected price as well. So the CBR are describing the house prices in the indices from the lenders as distorting the picture. So those house prices indices from Halifax and from Nationwide, the CBR are saying that is, it's actually distorting the picture. It's not painting the real picture of what the economy is saying. Now, this is what their argument is based on. The argument is based on what the pandemic has done to the economy and how the pandemic has changed the entire structure of the property market. Now, how has it done that? They are saying that the most affected by the pandemic are those on low incomes, especially in the gig economy, the 0 hours contract people, those who are self-employed and working on flexible rotational basis, or working on flexible arrangements in the gig economy. So those low income earners are the ones that are most affected by the pandemic. So because they're the ones that are most affected by the pandemic, they are the least likely to be in the marketplace. So the increased house prices means that especially with the high loan to value mortgage not being available, because those on low income are least likely going to be producing high deposits. So they are the ones who are most likely going to be demanding for the high loan to value mortgage products. Okay? But then the marketplace, according to the CBR, looks like it's skewed more in favor of high value properties, right? Because those in the marketplace are people who can afford to also buy those high value properties. So when you now average the prices of those high value properties, the average house price will tend to be on the increase. I don't know whether you're getting the analysis from the CBR. So now, because income has been boosted by the government policy and the job retention scheme, the furloughed scheme, people are getting paid by the government. And these people are getting paid and they feel rich, even though they are not as rich as they are. But they feel rich and they feel, well, I can go out and try and buy a property. The CBR are saying that's not a realistic reflection of what the situation would have been like, because these people don't even know whether they're still going to have a job after the furloughed scheme have come to an end in October. And now a lot of lenders are already adjusting their criteria around the furloughed workers. A lot of lenders are now beginning to reject applications from furloughed workers who they haven't got an assurance from their employer that they're going to go back to work on the same level of income. They are becoming stricter on furlough. Some of them are not even accepting any application from furloughed workers anymore. So you see, as we draw closer to the end of the furloughed scheme, the criteria are changing again, and the lenders are beginning to become stricter on that. So you can see why they are not very sure and very confident about bringing more products to the market, because nobody is sure what the government is going to do with the furloughed scheme when it ends in October. So the furlough scheme is going to end in October. The ban on repossessions and evictions are also going to end by October. And then by April 2021, the stamp duty holiday is also going to end. So you can see that the temporary nature of these interventions makes it unsuitable for the CBR to consider it to be permanent or sustainable, because according to them, these are all temporary measures. If these measures come to an end and the market is allowed to exist on its own, do you think these are sustainable or not? Now, add to the mix the pent-up demand from lockdown, which the CBR are saying are going to gradually ease out in the coming weeks. So in summary, the CBR are saying that they believe that towards the end of 2020, that house prices will start to lower significantly towards the end of 2020 and then into the first half of 2021. But then they are expecting a spike again in the first quarter of 2021, when we are going to be drawing close to the end of the stamp duty holiday. People are going to want to take advantage of that, and there will be, a very short window of a mad rush before that program ends. So we can see that based on these analysis, the CBR are saying that by the end of 2021, there will be, house prices will be 14% lower than they are as of 2020. So that's where the whole prediction is coming from. Okay? I hope I've done as best as I could to break down this analysis from the CBR for you to understand. Now, I am not saying you should take the CBR's analysis hook, line, and sinker. But what I've done is just to break it down and to tell you why they are forecasting this and why they think that this surge in demand is only temporary, is not sustainable, and is not going to go beyond the first quarter of next year. But around all these things, you can see the influence of the government and the government policy around all this. So it means that if the government decides to extend the furlough scheme like they are under pressure to do now by the end of October, the whole terrain might change again. If the government decides to still extend the ban on repossessions and evictions for another couple of months, the whole terrain is going to change again. If the government decides to extend the stamp duty holiday by April 2021, it's all going to change again. So the economy as well, job losses happening on a daily basis. I think as at yesterday in the news, it's about 1.4 million people now that are out of work in the UK. Unemployment has increased just slightly by, I think, 0.2%, to 4% recently. So that's why lenders are concerned, because they don't really know how the labor market, how the employment market is going to pan out. Because if people don't earn money, they can't pay their mortgages, they can't even take new ones. All right. So the uncertainty in the economy makes it really unpredictable. So nobody really knows what's going to happen by the end of October with the furlough scheme and the ban on evictions and repossessions. Nobody knows by the end of April whether the government is going to extend this stamp duty holiday again, which people are already calling for an extension of it even before they get to April 2021. So because we don't know a lot of these things, people tend to do what they've got to do right now. So if you want to base your decision to buy or not to buy on the analysis of CBR, I would say to you, consider your circumstance individually. There was a session I ran some time ago where I treated the topic, should I or should I not buy property right now. If you go to my Facebook page, you can see that session where I treated should I or should I. There are questions I posted there that you should ask yourself. And if you answer those questions, the answer to those questions will tell you whether you should buy or you shouldn't buy. Okay? So if you can get a mortgage now and you have an urgent need to buy a property, what you've got to do, you've got to do. Okay? Even if house prices end up falling significantly next year, I mean, if you've got to buy the property now, you've got to buy it now. If you don't have to buy the property now and you want to wait and see how the market, it's your call. But make sure that you have analyzed your personal situations and circumstances very well enough to say, okay, I want to wait based on my own individual analysis. It doesn't mean that what the CBR has said is actually going to happen. And it doesn't mean that it will not happen. But these are professional forecasts based on certain factors that they have put one and two together. And then it's now down to individual circumstances for you to decide whether to go by that forecast and base your decision on that, or whether to just carry on with what you're doing now if you're in the market for mortgage or for property, and you say, you think, well, this is an opportunity and this property, I think it's worth it. Because what you are paying for anything is the value you attach to that thing. If you think your property is worth £200,000, you pay £200,000 for it. If you think it's not worth it, you walk away. Okay? So guys, thank you very much for being part of today's program, and I hope this has been useful to you once again. And please feel free to share this video and this educational material among your friends, your family, your colleagues, and whoever you think is going to find it useful. And I will see you again on Monday when we come for our Modesty's Money Masterclass, and next week Wednesday again when we come for our Modesty's Mortgage Masterclass. Please feel free to drop us the feedback on what you think about this. Any feedback at all is welcome by us, whether good or bad, as long as it's constructive. Let us know what you think, and let us know what topics you would want us to treat for you, whether in the Money Masterclass or in the Mortgage Masterclass. We want to bring you topics and issues that are useful and applicable to you. Until then, goodbye, God bless, take care, and stay safe. Bye now.